This is Michael King. In this video, we're going to learn how to value a common stock using the dividend discount model. In the text by Booth, Clear and Rikita, this is Chapter 7, Section 7.3. We're going to be using the magic formula again to value a common stock. Just like any other asset, the value of a common share is the present value of all the cash flows that you will receive, discounted to today at some discount rate. In the case of a stock, it's going to be dividends, which are going to be received once a period, and we're going to assume annual periods, discounted at the cost of equity, which is also called the expected return on equity. So let's take a look. Here you see a stock that's paying dividends in periods 1, 2, 3, and forever. Unlike a bond, which is a form of annuity, a stock is a form of perpetuity because the dividends go on perpetually. The formula for this is going to be taking the dividends and discounting them, where we're going to be looking at all the future dividends that you would receive. Now there's going to be two forms of this model. The first form is where you see the dividends, but they do not change and they are constant. In this case, we're simply going to take the dividend in any period and divide it by the discount rate. With zero growth, the numerator is simply the dividend and the denominator is simply the discount rate. This is the same formula that we've used to value a preferred share with a constant dividend. There may be another. The second case is where we have a dividend that we assume grows at a constant rate, in which case we use the growing perpetuity formula. As you can see, we grow the dividend in the last period by 1 plus g and divide it by the difference between the cost of equity and the growth rate. Or we use the forecast dividend in the next period and divide it by k minus g. Let's look at some examples. What is the price of a common share if the dividend is $10 each period with no growth and the required return is 10%? This is a straightforward application of the dividend discount model, and it's the same formula that we used to value a preferred share with a constant dividend. In other words, with no growth, we simply take the dividend and divide it by the discount rate. In this case, 10 divided by 10%, the price is $100. Notice that G is set to 0 for no growth. This model, as I mentioned, is the same that we would use to value a preferred share, and this model will not work, of course, if the company does not pay dividends. A second model is where we know that the dividend is going to grow at a constant rate forever or in perpetuity, and this is going to be the constant growth perpetuity formula. Again, it's the same formula, except this time we're going to add a growth rate to both the numerator and the denominator, which is the top and the bottom of this ratio. Notice that we need to know what the dividend is in the future, one period ahead, and not the dividend that was in the past. When you buy a stock, you do not receive the past dividends, you receive the future dividends, and so you have to forecast the future dividend. We call this the constant growth dividend discount model. Some people also call it the Gordon growth model, after Donald Gordon, who was the first one to set it out. Just remember, you have to use the dividend one period in the future when calculating a constant growth dividend discount model. Let's take a look. So what is the price of a common stock if it will pay a $2 dividend over the next year? The dividend will then grow by 6% per year in perpetuity, and the cost of equity or discount rate is 10%. Plug in these inputs into the formula, we see that the dividend of $2 in the next period is divided by the difference between 10% minus 6%, or $2 divided by 0.04, and the price today is going to be $50. Okay, so now we've looked at several examples. Let's take a look at what the sensitivity of this price is to changes in the inputs. Okay, so let's just take the example of a common stock paying a dividend of $8. What will be the price if the market rate or discount rate is 5% and the growth rate is 0? Well, we're going to put the dividend of $8 divided by 5%. It's going to be worth $160. Notice, however, that if this discount rate is increased or the expected return is increased from 5 to 8%, still with no growth, what do you think will happen to the price? Remember that when you discount any future cash flows at a higher rate, the price today is going to be lower due to present value. If you take $8 and divide it by 0.08, the price today is $100, which is lower than the 160. Last example, what happens if the discount rate is 8%, but the dividend grows each period? So the dividend 1 year in the future is going to be $8. 2 years in the future is going to be $8.16, and it will continue to grow from that point forwards. If you think about it, the present value of a growing string of cash flows by itself should be worth more. So the price is going to be higher than simply the no growth model with an 8% discount rate. So we get 8 divided by 0.06 or $133. So now we see that the price of a stock really boils down to two things: the cash flows in the top and the discount rate in the bottom. Factoring in growth, we're willing to pay more for growth because dividends are going to be rising in the future. So now we've seen that this model is sensitive to changes in all the inputs. If you increase the dividend, it will lead to a higher price. If the growth rate increases, meaning the dividends are going to grow over time, it will lead to a higher price. If you increase the discount rate, which is the required rate of return, however, the present value of the future cash flows will be worth less today and the price will be worth less today. Always remember to use the correct dividend. You only get future dividends when you buy a stock, not the past. We're always looking to look at the dividend one period in the future. The only case where the dividend in the past can be used is if there is zero growth. That most recent dividend may be called the current dividend, the last dividend, or something else. You always have to know what the next one will be. Dividends are typically paid quarterly to make sure that you're looking at the annual dividend, not the quarterly or monthly one, for example. The other thing to remember is that dividends are a promise and they are not a contractual or legal requirement. They are not like interest on a bond where not paying interest can lead to an event of default and potentially bankruptcy. Companies can change or cancel the dividend at any time. And so when you're using this model, you are assuming, and it's a strong assumption, that dividends are going to continue into the future and the company is not going to go bankrupt. That was not always the case. Take the example of General Electric, which was one of the most successful companies through the 1980s and 1990s. General Electric, a 125-year-old company, actually had to cut its dividend in 2017 because of problems with its business model. Of course, by cutting this dividend, it would decrease the future cash flows, and using a DDM, we would see that the share price would fall dramatically. Once we know this formula, we can actually back out what the implied cost of equity or expected return, K, would be if we know the other inputs. Let's take a look with Royal Bank of Canada. If their share price is $108.75, the next dividend is expected to be $4.35, and dividends are expected to grow at a constant rate of 6%. What should be the implied return on RBC stock? Okay, well, the first part is simply the dividend divided by the price. So $4.35 divided by 108.75. You may recognize this as the dividend yield. You then simply add 6% to that number. What we see is that the dividend yield is 4%, the growth rate is 6%, the implied discount rate in this price based on these inputs is 10% per year. It is important to know what growth rate to use. We're going to be using a forward-looking growth rate, which is called the sustainable growth rate, G, which is a function of a company's profitability and how much of its earnings or profits are paid out each year as opposed to being reinvested. The measure of profitability we're going to use is called the return on equity, which is the ratio of net income over common equity at its book value. So this is an accounting measure based on the financial statements. The amount of earnings that is going to be retained and reinvested in the firm is going to be called the retention ratio. Another way of looking at this is you look at how much is actually paid out by looking at the dividends per common share as a percentage or as a ratio of the earnings per common share. So the retention ratio is 1 minus the payout ratio, and this is the amount of money that is being reinvested out of profits, which would be eventually recorded as retained earnings. So let's look at the sustainable growth rate for RBC if it earns a return on equity of 14.2% and pays out 55% of these earnings as dividends. Okay, using this formula, we see that ROE 14.2% times the retention ratio, which is 1 minus the payout of 55%. We see that the growth rate that is sustainable is 6.4%. This should make sense to you because effectively we're saying for every dollar of earnings that is reinvested in the firm, the company is going to find an attractive use for that, and it's going to generate profits of 14.2%. So if they only retain 45 cents out of every dollar, then the growth rate of earnings is going to be 6.4%. Now, how can you check if this is a good estimate for your sustainable growth rate? One way is to look at what the historical growth rate of dividends has been over time. Another would be to look into what equity analysts are forecasting as a consensus estimate for the next period, and then back out the implied growth rate. The other thing is to use your common sense. We're talking about growth rate that continues forever or in perpetuity. So if that growth rate is higher than GDP, which is usually 2 to 3%, over time, the company with a growth rate that's higher than that will eventually grow in your model to be bigger than the economy itself, which does not make sense. Let's take a look at RBC's dividends from 2000 to 2020, a 20-year period. You can see they started at 44 cents back in 2000. That's dividend per share over 1 year. And they've grown to $4.29 in last year, 2020. You can see that taking the change or from one period to another, or the growth from one period to another, you can see that back in 2001, the dividend jumped by 58.6%, a very large increase. It then dropped to 10%. It increased again, rising up to as high as 26% prior to the global financial crisis. It was then dropped to zero in 2009 and 2010 as firms were not allowed to increase their dividends. They were trying to build back their capital. And then it sort of growed at a different rate. You can see here that clearly the growth rate is not constant. So what do? Well, we try and take an average over different periods of time. Notice that if you took the full 20-year period, the historical growth rate would average to 12.7%. If we dropped that anomalous year in 2001, it would be only 10.3%. And if we looked at only the last 5 years, it would be 6.9%. As you can see, it's quite difficult to use historical growth rates to forecast what the future constant growth rate will be. If we were to use the sustainable growth rate formula for RBC, we know that its ROE was 14.2%. Dividends per share in 2020 were $4.29 on earnings of $7.82. So the payout ratio was the ratio of those two, dividends over earnings, of 55%, as we saw. And applying that, we see that the sustainable growth rate is 6.4%, which is slightly below the 5-year average. If we were to plug that into our single stage dividend discount model with constant growth, we would see that the implied share price would be $121.17, which compares quite favorably to the actual share price of $105.81. If you believe this model and those inputs, you would want to buy the share because right now it is undervalued at $105 and you believe it will rise to $121. So in summary, the dividend discount model is useful for firms that pay a regular dividend with constant growth. This model does not work for companies that have high growth rate and dividends where G is greater than K. Doesn't work at all for companies that don't pay dividends. And if a firm is private and you don't know what the inputs are, you have a hard time using this model.